In global markets, not all information is created equal. Some signals just show up hours before others, and that creates something called information asymmetry. We're going to dive into a theory that says this imbalance isn't random at all. It follows a predictable pattern. You could almost call it a law of capital.
Vector confirmed. To really see this in action, we're pulling a case study from the archives. On this exact date, a major market move was anticipated and confirmed. It's a perfect example of this information lag at work.
So you can see right here, the initial signal points to a pretty significant event coming out of Asia. Now, while most of the market was just sitting around waiting for the standard U.S. economic data, a truly crucial indicator had already popped up halfway across the world. Our system tagged this signal a full 12 hours before the U.S. market even had a chance to react.
Okay, let's break this event down. We're going to treat it like a case study to see if we can find a clear, data-backed link, a proof of causality, between that early signal in Asia and what happened later in New York. The number you need to focus on is this, 1.61 trillion Korean won. That represents a massive flow of institutional cash going directly into Asian semiconductor nodes. We call this a physical lead indicator. Why? Because this isn't just Wall Street speculation. It's real capital being deployed to produce actual physical hardware. And these heat maps, they just lay it all out. On the left, you see that surge of investment lighting up the Asian semiconductor market. Then, hours later, look to the right. A rally ignites across the U.S. tech sector. The takeaway here is that the first event didn't just hint at the second, it mathematically locked it in. It created a direct, predictable momentum. So, what's really going on under the hood here? How can something happening in Asia have such a predictive punch in New York? Well, the theory says this isn't just a fluke. It's all based on a principle we call the information gradient. And this is the core idea, supply chain arbitrage. It's kind of like seeing the lightning before you hear the thunder. The lightning, the actual physical event, it happens where things are being made. The thunder, that's the financial market reaction, it always arrives later. And that time lag between the two, that creates an information gap you can measure. This slide just visualizes that flow perfectly. You've got orders for critical hardware, like these memory chips, being placed upstream in Asia first. This builds up a backlog of real, tangible demand. So the financial reaction downstream in New York, it's fundamentally a lagging indicator. The real story has already been written in the Asian order books. But here's where it gets really interesting, because this setup created what we call a macro paradox. All the conventional wisdom, right? Hot inflation, rising bond yields, that makes money more expensive. That should have been terrible for tech. A sell-off was the expected outcome. But look at the table. The exact opposite happened. The indices surged. And that leads us to the central question, the real puzzle. Why did the raw physical demand for hardware completely override the macroeconomic fear that usually drives these markets? This moment right here is precisely where standard models just completely break down. Okay, so if those traditional macro signals can just be ignored, how do we use this framework to analyze what's next? Let's switch modes. We're going to look at how this supply chain data can be used to build a forward-looking model. Current state regime persistence. What this means is the buyer's need for AI infrastructure is the single most dominant force in the market. It's a theme so powerful it's completely overriding traditional fears, like the rising cost of capital. All right, based on that, the system is tracking two primary scenarios. Scenario alpha, we're giving that a 65% probability, is that capital will keep concentrating into those large-cap alpha nodes, the huge companies that are the backbone of the AI supply chain. Scenario beta, at 35%, is the risk that this trend is getting tired, what the system calls regime exhaustion. For scenario alpha, the data points to a very specific quantitative target. Based on the current momentum coming out of that upstream supply chain, the model is targeting the Nasdaq 100 index right around the 25,100 level. And for the counter scenario, the trigger is just as precise. It's tied to the VIX, the market's fear gauge. A sustained breach of 2054 on the VIX would be our signal that macro fear is finally starting to overwhelm the supply chain demand. That signals regime exhaustion. But of course, any signal needs confirmation. It's not enough to just see a price level. A core rule here is that all of these levels must be filtered by a huge surge in trading volume. We're talking 2 standard deviations above the norm. This is how we separate a real market shift from just random noise. We only act on high-conviction data.
So let's bring this all home. What we've seen is a structural, repeatable information lag between physical economic activity and the financial market reaction. So the real takeaway, the inevitable conclusion, is the need to find a way to consistently measure and standardize this lag.
And I want you to really let this sink in. If you trade U.S. technology without the Asian upstream flow, you operate with a structural information deficit. What that means is you are showing up to the party 12 hours late. You're operating at a huge disadvantage by design.
The main point here is that this case study we just walked through, it's not a fluke. It's not a one-time thing. It's empirical proof of a recurring cycle that's baked into the logistics of the global supply chain. Look, our goal isn't to give you yesterday's news. We provide the system to understand this information lag. The objective is simple. Standardize your information lag so you can secure the next vector. So the next time you see some market-moving news, you have to ask yourself, is this really the start of the story? Or is it just the echo of something that already happened, hours ago, an entire ocean away? Target acquired. Copy that.